So welcome everyone. Thank you so much for coming. Obviously, people are as excited as I am to have Andre here. Andre is from Scotiabank, and he's going to talk to us a little bit about the Scotia program and what it is that makes Scotia one of the absolute go-to lenders for us as real estate investors. And it's funny because for so long it was CIBC, and every investor was CIBC and CIBC. And Scotia just kind of came up in the last, I don't know, I'd say the last maybe 5 to 7 years. And I've just seen Scotia shoot to the top in terms of ability to work seamlessly and easily with investors. So, you know, we always appreciate having options. And thank you so much for your time today, Andre, to teach us a little bit about Scotia. So I'm just going to go over a couple of housekeeping items. Sorry, my apologies. We're just going to back up for 1 second here. Okay, so today we have the pleasure of Andre Matos joining us from Scotiabank. He is a home financing advisor, or an HFA. And our webinar topic today is Investors Love Scotia Financing, and more. Sorry, our topic today is why investors love Scotia financing. And we're going to be chatting with Andre about the Scotia program specifically, and how Scotia works with investors to help us build and grow our portfolio. So just a couple of housekeeping items for our webinar today. You will see at the bottom of your screen, we are in a webinar format. There is a chat box. So this is what you should see at the bottom of your screen. You've got a chat, and then you've got the Q&A. So I like to differentiate the chat boxes for us to use to comment back and forth. When Andre says something awesome, we can say, thank you, Andre, and just sort of keep conversation and dialogue while Andre is presenting. The Q&A box at the bottom, this is where if you have a specific question for Andre, this will capture this information and it will hold on to it. If you post your questions in the chat box, then they will probably get lost as the dialogue progresses throughout the webinar. So if you have questions for Andre, please make sure you hit the Q&A tab and you post your questions there. If you're just commenting or responding, please use the chat box. I find when we use the system, keeps everything moving forward so much more smoothly, and make sure that all of our questions, Andre is hopefully going to have time to answer all of them, because I know you guys probably have a million of them. So thank you so much for joining us today. My name is Elizabeth Kelly, and I am your host. I've been a real estate investor for 15 years. I've done a number of different strategies. I've been an elite trainer for Rich Dad, and I am now an investment coach and mentor. I have a property management company, and I am right now based in Kirkland Lake, although I am from the Toronto area. And I love connecting with investors all across Canada, which is fantastic, because that's where Andre services as well. And Andre and I met a couple of months ago. Actually, we were at one of Erwin Cito's stock hacking get-togethers, and Andre is super personable and friendly. So I had the pleasure of sitting with him, and we realized how many things we had in common, and how you know, we both are dedicated to serving investors and helping investors grow their financial well-being through a real estate portfolio. So Andre, in addition to being a real estate investor and a mortgage advisor, is also a ski instructor, and he has the most fantastic, fabulous wife who's a physician, and Andre and his wife are dedicated to helping other physicians achieve financial freedom as well, which is funny because so many of us think that physicians have so much money and that they must love what they do after all their years of schooling, and why would they possibly want something else? So Andre, I'm sure, will share a little bit of insight into that as well. And Andre, I'm going to turn it over to you and let you get started on the presentation. So happy to have you here with us today. Thank you for joining us.
Oh, yeah, I was mute. Sorry, apologize.
No, you're good.
So let me put that. So thank you, everyone, to come for this presentation. I hope I bring value to you guys. You know, something that as investors, we like to share what we learned, the process, all the path we took, the bumps we had. So I like to share, and I like to share as well, you know, why I became a mortgage advisor, the reason behind that, and how can I help people, you know, with this. So the presentation, oops, sorry. Okay. So the beginning, some disclaimer, the devices I give or endorsements, I've got to be careful with that online nowadays. I'm a mortgage advisor, so I provide advice about the mortgage for my clients. But aside that one, everything that I give you is something that happens with us and how you can use that one towards yourself. But sometimes you need to tip that one or change a little bit and get it better for you guys or apply for you guys. So I'm also, aside the Scotiabank, I'm a co-owner with my wife at the Impacts Holding Inc. We do, rentals. We buy properties. We do a lot of other things in real estate that I'm going to talk. So, like I said, who am I? I'm a retired IT. So I was IT in the previous life for 25 years. I have master's and PhD in medical science. Of course, apply to medical science. I left that one because of family time. My wife is a physician, like I mentioned, so it's hard for us, for time. So I decided to switch a little bit and become, do a real estate. So I'm a real estate investor. I'm a mortgage advisor. For fun, I'm a ski instructor. I love to teach ski. I'm a Brazilian, as you can see from my accent. But I love the winter here, and it's so fun to have all my kids and the other kids and friends skiing with us. So I love to teach. I'm a stock hacker as well with our own team. I love to invest my own money that for cash flow. I have two boys, so they keep us extremely busy, 12 years old and 8 years old. And like I said, and Elizabeth mentioned, I'm a husband for a physician wife. So she is really, really busy, but I don't think she's busy enough because she loves the real estate as well. So why am I a real estate investor? Why brought me, what made me left the IT field and join this real estate field? I want to diversify the investments, first of all, because we had everything in the bank with invest in stocks, but I want to have some diversification, more income. At the same time, based on retirement, we were looking, say, well, if I retire in one day, I need to have different sources of income. Consequently, I want to be self-employed. I don't want to have someone to tell me exactly what I do at the time that I do. I want to take lead, take charge, be in charge of what I want to do. And, I want have some rewarding and having fun as well, because in life is too short. We need to enjoy life and we need to have rewards and have fun. Okay. Why become a mortgage advisor? Since I am a real estate, I would say full-time real estate investor, because I want to learn more about financing. I want to see how I can get a mortgage. I'm not happy to walk or the branch or talk to a mortgage advisor, can be a mortgage broker or in the bank. I want to learn. I don't want them to tell me what should I have. I want them to explain the options I have and how I can make a wise decision for myself. The same thing I apply for my clients. I want to invest there. Once I learn this, I want to help my investors. I want to help people that wants to invest like us. And at the same time, I want to educate them. And by educate them, I get more knowledge as well. I learn more and more. So why Scotiabank? Okay, so there are 5 banks there. They're brokers. Actually, I was at the DLC, Dominion Land Center, and I was hired by Scotiabank, but why Scotiabank? Scotiabank, like Elizabeth mentioned, has been changing a lot, and now it has a very strong lender position. Okay, so we have a couple of very good products, and we get competitive rates, and we can offer for a variety of type of lending. We have let's say, for example, we have Scotia Total Equity Plan. People call outside home line equity. So it's the same thing, but a step mortgage for us. It allows us to do a lot of things, when people are moving or buying a new home or adding a line of credit. Scotia supports a lot of real estate investors, especially if you have a holding company. There's not a lot of lenders that like people that have a holding company. It's a different treat, it's a different, I would say how we handle this, the deal is a different process, and it's easy with us in Scotia, okay? Another thing that I love in Scotia is up to 10 properties. Not a lot of lenders have, Usually they stop in 3, 4, or 5. We can go up to 10 properties. After that is on exceptions based. Okay, it depends how you structure your properties. If you're a strong client of Scotia, we can go above 10 properties. Like I mentioned, we have great rates. We have a different mortgage products. Let's say one great people talk about is the purchase plus improvements. So you buy a house, but you want to buy and then you need to do improvements. Instead of open a line of credit, we can add a purchase plus improvements. So you get us some cash to do renovations. Okay. We have a stream dedicate. We have a stream dedicate underwriter in my process. So one thing that makes our life easy and make quick and efficient and affect the turnaround for us is to have a dedicated underwriter. So I work close with underwriter, and I call him. I get the phone. I call him to discuss about the deals that is going to happen or the deal that is happening. So we chat about, we see how we can structure that deal to get it approved. I think this is very important for us nowadays, and this reduces the timeline. So depending on the, I don't like to tell people that we take 24 hours or 48 hours to get a mortgage approved, but I work towards those time, depending on the week, depending on the volume as well. So here is how it works when you guys, we work together to submit the process, submit a deal for us, the process. So we split in 3 phases: submission, approval, and funding. The submission process starts when I start knowing yourself, knowing my client. So I'm going to ask a lot of questions about my client. I need to understand my client goals. I need to understand what my client wants to achieve in a short term, middle term, and long term, because this is important, especially for investors. Okay. I explain to my clients about the documentations I need, the information that I need. And I explain them how it needs to be done and why I need those documentations. All those information is not just say, oh, I need your paycheck, I need your pay stub, but why do I need the pay stub? Then once I have all this information and I verify with you, I will create the deal and I will review the deal with you guys before I submit the deal. So I'm going to talk about your ratios at that time. I'm going to explain how is your capacity, your power to buy property, not only the one that you're working, but the future ones. Then once we have the approval, we have an agreement between myself and my client, I will submit the deal. Okay. My underwriter will review the deal again because we spoke about the deal before I submit that one, but now he has all the documentations to review. He's going to send to the ACE department, who's going to review and get it approved. Okay. Once it's approved by the ACE, we have an approval issue, and then I have a commitment letter that I'm going to send to my clients. We're going to review online, or we're going to review via Zoom or in person. Nowadays, it's hard in person, but we're doing it via Zoom or over the phone. Once my client knows everything on that commitment letter, because that commitment letter can have 4, 5, 10 pages. So there might be some pending conditions on that that needs to be reviewed, some conditions. So I'm going to review that one at the same time, making sure that my client understands the process. What is in the commitment letter? What is his sign-on? What is the mortgage he's getting? Remember, I discussed with the mortgage before I submit that one, but maybe that one got changed during the approval process, and I need to clarify with the client if the client still wants that deal to be done. Okay. Once everything is satisfied, all the conditions are removed. Let's suppose down payment conditions is very fundamental. We're going to talk about this later. The down payment is not approved yet, is not satisfied. We can move to the deal for the funding process. We need to have all the conditions removed. Once that one is all removed, then we move to funding phase. The funding phase, the deal is committed. Then you're going to meet at the branch. Sometimes we don't have a meeting branch because, it's going to do by the lawyer, or even if it's signed with the lawyers, remember all the purchase needs to have a solicitor or a lawyer. Okay. But in addition, sometimes the bank requests to meet with the clients at the branch. Somebody else is going to meet with you, which is the CSA, Client Solutions Advisor, is going to meet with my clients to go over with the paperwork again, to make sure everything is understood by them, everything is good. Then once everything is done with the deal is instructed to your solicitor, your lawyer, and then comes the date of the closing, the deal is funded. Remember, all this process, some I'm involved directly, some are not, but I'm always following up and keep you updated. So once we have the satisfied pending conditions done and the deal moves to committed, you will get an email from me saying your deal has been committed. Okay, then you have, a branch meeting. I'm going to work with the CSA to set up a meeting with you to make sure that, depending on your schedule, to accommodate that one, I'm going to work with the CSA and you to help on that one. Then once the deal is structured, you're going to get an email from me saying the deal is instructed. We're going to follow up with your lawyer, your solicitor, to make sure they receive the documentations. They're ready to move forward and get you a meeting to sign the documents. And then once the deal is funded, I'm going to send you a note saying that it's funded and a thank you letter about, being the trust and being my client. So talking about qualifying for mortgage nowadays is very important. That's a very important phase for us. It's not, sending the documentation, talk about everything is good. But if you don't qualify for mortgage nowadays, and we have this stress test nowadays, which I need to get you approved following the stress test, which is, people don't know, is 25 years amortization. And I need to use a benchmark rate of 5.25. So if you don't qualify for that, for the mortgage or for the purchase, we cannot move ahead, okay? There is no exception for that, okay? I will verify your down payment. So we need to talk about the down payment. Down payment needs to be 30 days prior to the closing. Okay, it needs to be an account. If let's suppose you have investment outside and you're moving this money around, I need to have a paper trail for that one showing from where the money came from and to where the money goes to. Okay, we need to prove that one that you have the down payment. We're going to talk about, employment income. It's fundamental, depending if you're self-employed or you're full-time or your business, it depends. It has different documentations and different qualifications as well. Affordability, we're going to talk about how we structure your mortgage payment to help you. About the frequency of payments, going to be, monthly payment, it's going to be bi-weekly, it's going to be weekly. And we're going to talk about that. We're going to talk about, options for prepayment of your mortgage. Can I pay, put a little bit more down every year to help pay fast my mortgage, okay? It doesn't happen quite often for us as investors, but if we're buying, as an investor, I'm moving to a new house, I need to structure that way that helps me and it does not affect my ratios and my capability to buy more properties as well. There is a credit history as well. Then we do a credit check. That's a hard hit. There is no soft hit on this market. Okay, if people tell us that one is not okay, it is a hard hit. So try to avoid as much. And on my process, remember on that one that I mentioned the steps I do before I submit the deal, before I review the deal with you. I have not checked the credit score history yet. Okay. I have not pulled your credit bureau. I'm going to trust the numbers you provide me on the information I collected. Then I review you and I discuss with you and you say, yes, Andre, I want to move forward. Then I go and I pull your credit bureau. Then I go back for another meeting with you to tell you, to discuss about your credit bureau, to tell you your credit score. You may know, you may not know, but what is inside your credit score? What is affecting your ratios? Things that can be improved on your credit bureau. So I'm going to help you on that one as well, okay? And then the last one that I always talk about is the appraisal. For us as investor, we need to do two appraisals. We need to have a proper appraisal for the market value to confirm your payment, the purchase amount that you purchased. But also, if you're going to rent that one, I need to know how much is the rent market for that property. You can tell me that you're going to get, let's suppose, $3,000. You expect to get $3,000 on that market. You may get it. You may get it even more. But I need to know the same thing. The market. If it's 2,800, then I need to do 2,800. If you think that it's 2,800, 800, but the appraisal comes 3,000, it's a win for us because, we expect more. It's going to help you in the ratios. Okay. And I'm going to talk about the rental, how the rental affects your ratio very soon. Okay. So how much do I qualify for? There's two ratios we talk about it and I check all the times and I discuss with the client. Is that called GDS gross debt service ratio, but also the total debt service ratio. The difference on those two is this other payment that we have here. Let's see if I can use my mouse here. On the second column, we have other personal credit obligations, okay? So when I use the total debt service, okay, I need to add everything else, let's suppose, aside the property tax, heating costs, secondary finance that you have, or 50% if it's a condo fees, I use 50% of the condo fees. I also need to use, if you have credit cards, revolving debts, line of credits, lease for car or finance for your car, any other obligation that is not your normal payments that you do for, for housing, okay? For the gross debt service, we could go up to 39%. So we divide that one by your gross income, not the net income. People think that they need to provide the net income for me. I want your gross income. Okay, and sometimes your gross income will change. Let's suppose people come to me and say, well, my notice of assessment from CRA, my NOI tells me that I make $100,000. Okay, that's great, but I need to see your T4s to confirm that you make $100,000. Maybe you get a bonus, maybe you get a commission. Those numbers are different. It's different when I qualify you. Okay, so we can go up to 39% of the GTS. Okay, and for the TDS, we can go up to 44%. There is exception. Can I go above that one? Depending on the scenario, depending on the client, depending on the income, yes, I can go a little bit above. I can go probably sometimes 45, 46. It depends on the client. Every single client is a different situation for me, okay? But if I'm a real estate investor, we need to take in consideration if you have property, if you don't have a property. Okay, invest income property. Let's suppose you do not have, it's your first time you're buying a house. I'm gonna take 50% of the project month income that you're gonna have. The other 50% is to cover condo fees, property management, maintenance, everything else, vacancy rates, everything. So the bank will consider only half of the income. So if your mortgage, your rent income is going to be $2,000, I'm considering only $1,000. Okay, from that $1,000, I'm going to subtract from your mortgage payment. How much mortgage you have? If you have $500 mortgage every month, which means that you have a surplus of $500. That surplus goes towards your income. It helps you to boost, to elevate a little bit more your capacity or power to buy properties. Okay, if you're going to pay, let's suppose your rent is $2,000, but the half of that, so we use $1,000, but your mortgage is $1,100, which means that you're $100 shortfall. That number, $100, goes to your liability. Okay, so I need to use this income as well and the expense from your rental to help you and to qualify yourself. If you have more properties, then I need to go property by property. And again, to tell you if you have a shortfall or surplus in each property and overall for all your properties, how much you have for shortfall or how much you have for surplus. That helps a lot. And some people don't consider that one. I consider one because it helps you to qualify as well. Okay. Remember, we're not talking here about, okay, my property I purchased for $500,000. Now it worth $1 million, but I'm a shortfall. That's okay. That one's going to be your net worth, but it's still affecting your ratios in a sense of for affordability. Okay, so it goes towards your ratios. Okay, when I look at the client, I always assess my client and the deals, the property that he's going to buy, with using the 5 C's. Okay, you always need to use that one. Every single lender will use that one. And remember, there is banks and there is monoliners. They all use the same criteria. We need to check your character, sorry about the English, the accent, capacity, capital, collateral, and condition. I need to check all of them. And I will tell you which one of them I'm going to explain, and I'm going to tell you why we use each one during the process of your deal. Okay, when I structure your deal. Okay, so how I structure the deal in the sense that if I'm financing or refinancing or I'm switching, switching is people maybe don't know, it's coming from another lender. Let's suppose you have a BMO or RBC mortgage. You want to change that mortgage to Scotia. We're doing a switch. It can be a combine with switch and refinance. We do those two together, which means that you're moving from the other bank to Scotiabank. And at the top of that, I am also refinancing that one, getting capital, access capital for you. Okay, and there's port the mortgage. So let's suppose in the case you're buying a property for you, and before the end of the term, you said, I got relocated from my company, but I don't want to break my mortgage. I just want to port that mortgage to my new property, or my family grow. I need to buy a house with more rooms. So we're going to port their mortgage. You're going to help that one. And that port mortgage, I'm going to use the step product that I mentioned to you guys to help minimize the impact, the penalties, everything for you guys. Okay. Some of these products we can use with personal, we can use with rentals, but some depending how you structure your, let's suppose if it's a business, some products will be able to do it, some I will not be able to use some products. So it's a case by case, client by client analysis, like I mentioned to you. I always do 80% loan to value to my clients. I never ask my clients 75% or 70%. So which means 20% down payment. Can the ACE department, the department that gets approved, can the ACE request a little bit more down payment? Yes. But when I structure my deal for rentals, it's always 20% down. Okay, that one is to help you guys not to use all the source that you have as a down payment for the first property or for that one. Okay, rates, I can give you fixed rates and variable rates. It depends on the taste. I always explain the pros and cons, and I'm gonna see some slides here. I'm gonna compare both rates, the pros and cons in each one. Terms, we have open and closed term. Open term, people don't know. Let's suppose we talk about 3 years fixed mortgage, 5 years fixed mortgage. Those are closed term. Open term is you get a mortgage, but you don't know. You maybe get a mortgage for 3 months, 4 months. You don't know how long you take. You get an open term. The rates are insane on that one. It's like 4%, 5%, 7%. Okay, not joking. Why? Because the bank doesn't know how long it's going to have you as a client. Okay, on a closed term, the bank knows if it's 3 years, bank knows that you're going to be client with the bank for 3 years. Okay, we can do up to 30 years amortization, and I suggest for my clients, special real estate investor, always 30 years. You pay more interest, yes, but remember, interest is tax deductible. Okay, it helps you and your cash flow. Okay, so always I get you a rate for 30 years. People come to me, sometimes people buy primary residence, and I want to pay fast, I want 10 years. Say no, we're going to get 25 years, and I'm going to help you to structure the mortgage that you can pay it faster. You can do prepayments. We're going to talk about the prepayments very soon. Okay, monthly payments, how frequent? I would say monthly, bi-weekly accelerate, or weekly accelerate. There is no so much difference between weekly and bi-weekly accelerate, okay? For rentals, it depends on your goals. Usually, I suggest people monthly for rental properties, but it depends if you have the income and you want to pay faster, it's depending on your goals. Prepayments, like I mentioned to you here, if you want to pay faster your mortgage, we have 3 different products. We have 10 plus 10, 15 plus 15, 20 plus 20%. What does it mean? The 10% you can increase on your mortgage payment. Let's suppose your monthly payment, you pay $1,000 every month. You can increase another $100 every year. Okay. The other 10% is a lump sum that from the mortgage amount that you did. So if it's 800,000, you can do up to 80,000 every year. Up to, remember, doesn't need to be 80,000. You can do 5,000. You can do 2,000. You can do $1,000. All this go towards your principal. It goes towards the end of the mortgage. So at the end of the term, you're going to have a lower balance. It's going to help you when you renew your mortgage, you pay less. Okay. So we talk about as investor, okay, should I refinance? When I need to refinance? For me, and I tell my clients and I help them and I help investors that are learning, there's 2 reasons we refinance rentals. First reason is to have access to capital. If I need money to buy another property, that is a time for refinance. If my property has equity. Okay, so let's suppose I bought it for $1 million. I got a finance for 800,000. Now the house is worth 1.2, 1.3. The extra for the 20%, the 80%, I can get it again and use towards getting access to capital. Okay, I will explain to my underwriter. I'm going to talk, say the client will get access to this money. We're going to take another 100,000, 150,000, and we're going to inject another property that he's looking to buy or she's looking to buy or they're looking to buy. Okay, I need to explain this, and we need to have a clear, clear view what we're going to do here, so the bank knows exactly what is going to lend you the money. Okay, the other reason will be to reduce the rate. We had this happening a lot last year. We still haven't seen that one this year. People had a mortgage with 3.5%, 3.6%, 3.7%, and now the rates are lower than 2%, depending on the scenario. We can reduce the rate. Okay. Consequently, we're going to reduce your monthly payment. You're going to have more money left on your account, so you can use that one again to buy new properties or to do a renovation. If I can combine both of them, I would say that is a win-win. Some of my properties that I refinanced last year and I refinanced this year, I was able to associate both of them. Okay, so I not only have a lower payment, which makes my cash flow better, which makes my deals, future deals with the bank stronger, okay, because now I have surplus instead of shortfall, but I also have access to capital to buy more property, to grow my portfolio. So those are the two scenarios. And for every single of my clients, there are investors. I talk about those two when I assess the whole portfolio. And I'm very clear with my clients. I will never ask you to switch a bank to us if it's not worth for you, if it's not a good deal for you. I will respect the deals and the banks, the other deals that you have with other banks. I would love to have them, but I would not tell you, oh, you're not going to save money, or it's not going to be nice for you or worth for you. I am not going to ask that one. I'm going to review. I'm going to keep that deal until comes the time to do it. So if we talk about refinance the property, we need to talk about penalties. People don't think about penalties, and they get stressed up when I tell about that. Okay. It's very important about, especially when we break, before maturity, like I said, getting access to capital. Okay. If we have a variable mortgage, you only pay 3 months interest. So let's suppose you have a variable mortgage, you have it's $300 interest per month, you're going to pay $900 plus a discharge fee, which is $200, $350. So you're looking for $1,200. Okay, that's your penalty. What about if I have a fixed mortgage for 5 years? So I have 5 years term. The bank is expecting to have that one for 5 years. I break that one in 3 years. Get ready for the interest rate differential. Okay, that is not only 3 months, is the difference between what the rate the bank gave to you and what was the benchmark at that time and what is the benchmark nowadays. Okay, that calculates the differential. That one is going to affect your penalty. And I can tell you, for the other one was $900. This one will probably be $1,200, $1,500, $15,000. $12,000 or $15,000. Okay, so be careful when you choose the rate. And like I said, I'm very clear with my clients. I show what is the pros and cons about getting a variable, getting a fixed rate. Okay, because it's all depending on your goals. Okay, and like people don't know, but the life expectancy for the mortgage in Canada is average to 3 years, 3 years and a half. So the majority of Canadians will break the 5 years term mortgage in 3 years, 3 years and a half. And I don't be shy. Banks and lenders makes a lot of money on the penalties. Okay, think about it. The bank don't keep that one. Bank makes money using your money. So if banking has your mortgage, he put that mortgage together in a pool and sells to other investors. So when the bank needs to break, you break the mortgage with the bank, you're not breaking that one with us. You're breaking with those investors. You got to pay them back, and you got to pay the penalties with the bank as well. So be cautious about that, the average length, the time for the mortgage, because if you're planning, and life's, bumps, happens in life. You get divorced. You need to grow. Your family grow unexpectedly after, COVID-19. You need more space in your home, or you change your portfolio. Like it happened with us last year. We changed a couple of properties, and this year we changed more. And all these properties, 2 of them were fixed mortgage. I can tell you, it's not funny paying $35,000 penalty in one property. Okay, so get ready for that when you choose fixed rate. Okay, the other thing that people don't remember is that if the bank give you any cash back, any incentive, any fees that the bank pays when it gets your mortgage for you, you gotta pay it back. So if you got $5,000 at cash back, it help a lot when you're closing. It's great, but make sure that you don't break the mortgage before the term, because then you need to give that money back to the bank. The bank is just give you that one for you to stay for the term that you agree with us. Okay, so let's compare the rates just to see an example here between a fixed rate and a variable rate. So I put a mortgage balance of $400,000. I get a 5 years fixed rate for 2%, and I get a 5 years variable rate for 2.45. Okay, those rates are not real rates. It's just for an example here. Okay, and I get 25 years amortization. So my monthly payment for fixed is going to be $1,694. And for variable, $1,782. So people will come to me, oh, okay, that's great. I'm paying more here, so of course, I'm gonna go in a fixed rate because it's 2%, okay? Interest paid over 5 years, I'm gonna pay more using variable because I'm paying less principal and more interest on that one. The total that I'm gonna pay, the principal, I'm gonna pay $13,505 with a fix and $12,000. So less here again. And then the balance of the end of the term, I'm going to have $335,000 mortgage balance when my mortgage renew in 5 years. And I'm going to have, $338 for the variable. It looks like if I look at the scenario, people say, well, it's no brainer. I'm going to 2% fixed rate. I'm safe. Okay. What happened if you break your mortgage in the 3rd year? Okay, what happened with your savings? And remember, I'm not taking here into consideration that the prime rate went up or went down. I'm just fixing the prime rate here as 245, otherwise it gets too complicated. Okay, so same mortgage balance, same rates, same term, same amortization. The only difference that I broke my mortgage now. Okay, in the 3rd year. Now, the cost of breaking that mortgage in a fixed rate is $14,000, almost $15,000. Okay, for me, when I break the variable, I only pay $2,216. So if I compare those penalties, wow, I spent $12,000, almost $13,000 more to break my mortgage. Okay. How much did I pay more in interest rate on those 3 years? I only pay 16. So if I subtract this one here, I still have $10,000 difference. Okay. Not only that one. Okay. So it isn't, people get confused about, well, just because my rate here is higher, it doesn't mean that you're not saving money at the end of the day, depending on the scenario, depending what happened to your life, okay? So I like people to understand the difference, very clear about fixed rates and variable, and what the benefits they tell. It's great to have a fixed mortgage for 5 years. I know that I'm paying $1,694 for the next 5 years, every single month, 60 months, but sometimes people can get savings here as well. Okay, remember 2.45 is the prime rate nowadays, depending on the bank you are. Scotiabank is 2.45. If they give you a rate of 1.45, it means that I'm giving you a discount rate of 1% for you. Okay, so if the prime rate becomes 3%, you get 1% of the 3%. So now your rate instead of 1.45 is going to be 2.45. Okay, so as you can see, it is important when I explain to my clients that rate is nice. It's important to know your rate. It's important to compare your rate, but it's not the only factor when you get a mortgage. You need to know all the components for your mortgage. Okay, everything comes into the planning, and everything can affect your capacity and later on how you work with if you need to break or refinance your mortgage. Okay, so when I talk about documentations, and I joke, sometimes I tell people, and I make, I tell them that the documentations for investors, it's a lot of documentations. And the more properties you have, the more I'm going to ask. Okay. Bank lenders overall needs to ensure they will never have the product back to them. Let's suppose you're never going to default on your mortgage. Okay. They have everything in place to secure that one, and they don't want to have that property coming back to them, so they need to sell that one. So they will ask you a lot of documentation. So don't get mad to me when I ask you documentation, and organize your documentation in a way that anybody can understand. Sometimes I get documents that, it comes like I ask 3 months bank statement, it comes statement 1, statement 2, statement 3. I like people to help me because then I can do your deal fast. So put, let's say, August statement, September statement, and July statement. Organize that one, and I said, oh, it's a business statement. So let's say corporate statement for August, corporate statement for July, personal statement. So try to name your documents. Try to have all your documents digital, in a digital format, in a folder, so it's easy for you to submit the documents to me when I request. Okay. Overall, what do I need? I have a custom authorization form, which is a consent form that you need to review and sign. Nowadays, I'm doing e-consent, so you don't need to sign that one, but you need to review that form. I need your driver license. I need or passport, or both, depending where you came from. Okay. I need to know you, and I need to show to the bank that I know you, and I need the information on that one, expiration date and ID. So, second, I need 2 years tax return. Now it varies if you're incorporate or not incorporate. I need T1 generals, T4s, and T5s, and notice of assessment from CRA. And if you have any tax that you pay, I need an account statement showing that you pay those taxes that you want. If you are a full-time employee, I need 3 most recent pay stubs. I need an employment letter. It cannot be older than 60 days. And the employment letter, it needs to be very transparent, and it needs to cross-reference with your pay stubs. For example, in your employment letter comes saying that you make $80,000 a year, but when I check your pay stubs, you only receive $70,000 a year, $10,000 less. Okay. Well, maybe you get the 80,000 because you get $10,000 every end of the year as a bonus. That's great, but I need to know that one. It needs to be in the letter. If not, then there is a discrepancy between your pay stub and your employment letter. If you are self-employed, then we're going to go back to the T1 general here. I need the full T1, okay, with all the sections, and I will need the T4s and T5s as well, because the T5s will tell me if you take dividends or you have extra incomes as well. Okay. I need 3 most recent investment statements and bank statement, especially for down payments, but not only down payments. I need to show to the bank that you have been made in savings time over time. We have a lot of fraud nowadays, and it's one good example is like a 20 years old coming to buy a $2 million home and have $400,000 as a down payment. 20 years old, how he saved $400,000. Well, maybe he got a gift letter from his dad, who is, have a very good high income and is helping the kid to buy the house. I need to know that one. It needs to be here clear on the bank statements, needs to be clear on all the savings that the person has, special for rentals. If we are going to have payments, income from the rentals, I need to have the most recent bank statements showing the deposit of the rents. Okay. And when send that one to me, I need to have, if you 1 month, instead of you have $1,000 rent income from that unit, but it comes $1,100, what is the discrepancy between 1,000 expected and another $100 extra? It is maybe utilities that you collect or some extra fees. What happens if it's less? Okay, the person could not pay $900, or you gave a discount because you're doing renovations, it's dust the unit. So you make him, you want to help. One example, my tenants for new properties, they don't have sod, and then comes the builder and put the sod in the back of the house. They're going to spend money putting water every single day, otherwise the sod will die. So I give the monthly, the discount for them, not in the rent, but I don't charge the water. Okay, but one example, you give something for them, you need to show to me why there is a discrepancy between what you expect to receive as a rent and how much you actually received. Okay, and I need to have all those 3 months statement, and I need the lease. I know the lease. I need also the rent income, like I said, proper tax for every single property you have, including your primary residence. If it's a condo, I need the condo fees. Okay, and also if you're incorporated, I need the articles of incorporation, and I need the most recent financial statement. Sometimes I don't send all this up, and if you buy a property, I need the APS with all the schedules. Okay, the agreement of purchase and sales. I need the MLS listing provided by, this will be generated by the realtor for you, and you're going to send to me in PDF format. And if you put $20,000 as a deposit, I need that receipt, because remember, this is part of your down payment. So it comes less than here. So if you have $100,000 as a down payment and you did $20,000 as a deposit, which means that you just need to come up with another $80,000. I need to know that one, and I need to show this to my underwriter. Okay, so going back to the financial statement, this is very important if you're incorporated. Okay, sometimes you have that business for many years, and it's active business, it's making money, but you're taking a small dividend or a small salary every year, so you're deferring your taxes. I might be able to use some of your income from your corporation to boost your income, to help you to qualify, okay, to make your deal stronger. Okay, so like I said, some of the documents I will send to the writer, others I will keep to myself, just to understand more the deal, to see if I can structure the way that I will make sure that you will get it approved. Okay, so what do I bring to the table? How can I help you? Why choose Andre? Why not choose another HFA or like a mortgage broker, or going to walk into the branch and get a financial advisor there? I'm there before, during, and after your mortgage. I'm not saying I'm there for your lifetime of your mortgage, because I don't know if I'm going to be alive in 10 years. I expect to be, but real estate investment is so great that keeps me 120% busy, so I cannot do mortgage anymore. But I will be there on your deal before, during, and after. Why before? Why after? Everybody's doing the deal because we're doing the deal. Because I need to understand you. I need to know if you can buy. A lot of investors come to me just to assess the ratios before they buy the property. What is my, can I purchase $800,000 investment property? And I will do the analysis with you. I will teach you how to do the analysis, so you can, of course, you're always welcome to come back and review with me as well. But I also will do after your deal is done. So you purchase your first rental, or your third, or your fifth. After we close that one, let's go back and review your ratios again. Let's make sure that you still qualify to buy another property. We don't want you to stop in 2 or 3 or 5 or 10. I want to help you to buy more. That's my goal. That's why I become a mortgage advisor. Okay. Provide education. I think it's all about knowledge. I joke that we go to a dealership to buy a car. We know everything that we want in the car. We know exactly the car we want to buy. We go there just to talk to the guy and say, hey, can you tell me if there's any new feature or new things in the car? But people walk and say, well, I just need a mortgage. I bought this property. Give me a mortgage. No, I don't think that should work that. Mortgage is a very high debt that, I tell that there's a good debt and bad debt. Mortgage for investment is a good debt. Mortgage for your primary residence is a good debt because it goes up in value, appraise over time. So you need to know what you're getting. So I need to provide education and knowledge for you. That's my goal, okay? I need to provide the best solution. Not every single client is the same, so they're unique, okay? So you have a different situation for all of the clients I have. So we need to study your situation and find the best solution for you, okay? I want to fight for your deal. I joke with people, well, but you're in Scotia, but why you're fighting my deal? You work for Scotia. Hold on. I'm 100% commission, which means that if I don't get your deal, I don't get paid. Okay, so I need to sell your deal. I need to make that your deal get it approved. And I like that one because I work towards you, not towards the bank. Okay, so the more I can help you, the more I can structure your deal to get it approved, I will do it. The more I talk to you, if I call you 10 times, don't get mad with me. I'm not sure of something. I need to understand your deal. Otherwise, how am I going to sell something that I don't understand, correct? And I don't create fake expectation. I want to work with something that I can, provide. So if I tell you, unfortunately, we cannot do this deal, trust me, I cannot do this deal. Maybe somebody else can find a way to do it in a other way, but I don't work those ways. I don't do shortcuts. I work in a way that I can structure you for future purchase, not just that one. Okay, so I don't create, I create realistic expectations. Okay, and remember, I'm not only a mortgage advisor for Scotia. I started Scotia last year in May 25th, before I was at the broker DLC. All my deals at that time, they were with Scotia. I move every single deals from BMO, RBC, TD, whatever, monoliners, move everything to Scotia. Why? Because they had the best product. They still have the best product for myself. And here I'm talking separate from the mortgage advisor as an investor. All my mortgages are with Scotia. Okay. And I structure that one the way that I keep growing with them. Okay. And as a mortgage advisor, I can tell you I have the best products. Why? Because I'm using the same product I'm offering to you. Why I'm going to offer you a product that I'm not using? I don't sell the same one. So that's one another thing that I bring to the table for you. Okay. I put here a couple of, yes.
Sorry to interrupt you. We have 7 minutes left and we have like 12 questions.
Oh, sorry. I love to talk, as you can see, right?
I know, it's awesome. So I just wanted to give you a heads up on time. If you have a couple of minutes to stay later, then if people want to stay later and have you answer, that would be great. But if not, then people can always connect with you afterwards too. So we'll let you wrap up and then we'll do what we can with the questions.
Okay, so I have only 2 slides. Thanks for reminding me. Like I said, I love to talk, so we can spend the whole afternoon talking here. So there are a couple of tools there, and I'm free. I'm happy to share those tools for you guys to help as well. All these ones is in the website from mortgage, scotiabank.com/mortgage. You can find all of that, and I'm gonna give you my email address, my phone number. Okay, you guys are free to text me, to call me. If I don't answer the phone right away, it's because I'm in the meeting with another client or I'm after hours. I also meet with clients after working hours, depending on the days, okay, to help them because, sometimes we work the whole day. We only after 6 p.m. we're available, so I'm there. One thing that I put on this slide is that like people surround themselves with something that I learned as an investor. You gotta, if you want to grow, if you want to succeed, you gotta surround yourself with right people. You need to learn and you need to educate yourself, but you need to have an accountant that is a real estate investor or knows. You need to have a lawyer that understands real estate. You need to have a mortgage advisor as well that helps you. A real estate agent that knows how to help you to buy or sell rentals property as well. So you got to surround yourself. And like I said, I'm here for the whole process for you guys. Okay. So thank you again. And let me know if you guys have any questions and how can I help you.
That was awesome. Thank you, Andre. So can we do you mind? I'm just going to stop your screen share for you. And do you mind if we do sort of like rapid fire questions where like I'll give you like 30 seconds or less to answer?
Oh my God. Okay, that's fine.
Okay. All right. So the first one that's been a fairly common question is about working with multi-tier corporations, the structure that's familiar, the 3-tier structure that's common for real estate investors. Now, Scotiabank doesn't have an issue with that, right? They work with corps, no problem.
Yes, we work with that.
Okay, perfect. And so when you said the 10 properties, that could be either in a personal name or in a corporate name, no issues with that.
No issues with that.
Perfect.
As long as you qualify. Remember, qualification, stress test. You need to pass on that one.
Gotcha. Does Scotiabank have any issues with financing flip projects? Or Burrs, have they got any issues with that?
No, but we need to structure that one. We need to know the property, and I need to have all the information, what you're doing, where you want to go, because otherwise it can get complicated and your deal can be rejected.
Okay, perfect. So we need to set it up or structure it properly. That's fantastic. Okay. So would Scotia do a 6-unit property in their commercial division? Like when we start talking about anything over like 5 units and up, we're talking about Scotia commercial, right? So that would be a different person, and that would be a different product and different rates and everything else.
Yes, then it changed. Remember, you're not qualifying yourself anymore. It's the property that qualifies.
Gotcha. Perfect. Okay. Can you port a mortgage from one rental property to another rental property, or is porting just for primary residence?
Only for primary residence, but it's case by case, not inside the corporation, not inside the holding, not allowed to. If it's personally hold, maybe we can port depending on the property. Okay, case by case.
Perfect. Okay. Does Scotia have any issues refinancing a private mortgage? So if somebody bought a property, did a BRRRR on it, and so the buy, renovate, rent, refinance, repeat?
No, not at all. I will give you an example. We buy pre-constructions, right? And after 3 years, you go there and close. Sometimes what we do is that we close in cash. Cash, what I say, line of credits, everything that I have, combined, paying cash the property.
Yeah.
A month later, I go to the bank, say, I need the finance for this property. And I take all the down payments I did, all the appreciation I did. So yes, we can do it. And I have done that one personally before.
Fantastic. So if one of your income sources is private lending, how do you take that into account for qualifying? That would be on the T5 on the T5 summary, right? So when you declare the income that you made from private lending, then that becomes part of your financing qualifications.
Yes, just one comment here about private lending, okay? You cannot have a second mortgage on your mortgage from Scotia or the majority of the lenders, okay? So just be careful with that. If you're planning to increase your down payment or your property went up in value, but you want to take money quickly, you don't qualify in the bank, be careful, because the bank does not allow you to have a second mortgage on those ones. And it's written there when you sign with your lawyer. Just be careful, otherwise you can lose. If the bank realizes that you have a second mortgage, you can lose. They can pull all your mortgage, and then you don't have mortgage on that property anymore. Okay, just be cautious with that.
That's a great tip, because most people assume that, well, as long as nobody tells Scotia directly that I put a second on, they'll never know. But that's true. When you go to refinance or when you go to buy a new property, they're going to see for sure. I think this person, Leanne, was looking at it from the perspective that she lends money out. So she wanted that to count towards her income so that she could buy future properties. But so T5 income, do you need the same 2 years of history for it to count? So if she's doing it in her first year, it doesn't matter if she can provide a copy of the loan or the mortgage agreement. It has to be, that income has to be, okay. And she's talking about to prove the funds.
Yeah, remember, everything that varies is not a fixed salary or fixed income. We need to use 2 years average. Okay, so let's suppose commission, income from investment, like, you're lending your money to somebody else to make income. It's going to be your T5s. It's going to be on your tax return, that one. I can use that one. But if I don't have a history, I need to use the basic amount. Okay. If you get a bonus, 2 years as well.
Okay. So what I think I'd like to do right now, I'm going to wrap up the webinar. And there's still some questions here. So if you don't mind hanging around for a couple more minutes, we'll answer the other questions. But I want to give everybody who needs to get back to work an opportunity to get back to work. Hold on one second here. And there we go. So where's my share screen? There we go. All right. So thank you so much, everyone. This was I think I want to call it like an action-packed webinar because honestly, Andre, you're a fantastic presenter. You took so much information and compressed it into such a short period of time. I know that this webinar is going to be rewatched multiple times. Thank you so much for your time today. If you are looking to connect with Andre or myself, here is our contact information. And I do have another webinar coming up, actually, which I'm going to share with you as well. So on Monday, October 18th, we're going to be talking about creating unforgettable partnership opportunities, the ins and outs of joint ventures. So when you reach the point where Andre is like, I love you as my client, but we're maxed out, like we can't do anything more, or you're looking at the bigger buildings and you really need joint venture partners. So we're going to dive a little bit deeper into that. For those of you who know and love Andrew Brennan and Quentin D'Souza, they've been friends of mine for years and years now. They're embarking on some super cool projects in Kingston, and they literally wrote the books on some of the books anyways on the Burrs strategy and partnerships, and they're really dedicated to helping people achieve wealth, whether they know a lot about real estate or not. So hope you're able to join me as well on Monday, October 18th at 7:00 p.m. Thank you so much for your time. I'm going to let the recording keep going so that we can share that as well afterwards, but thank you to all those of you who have to get back to work. It's been such a pleasure to have you join us. And are you ready for your next couple of questions, Andre?
Yes, I am. I'm glad to be here to help.
Okay. So if I am planning to build an additional dwelling unit in the backyard, can I get Scotiabank to finance based on the ARV after it's completed?
We need to assess to see, we need to do an appraisal, we need to see the project first. Sometimes what I suggest to clients to get a line of credit, like a stepped line of credit, so you can use towards that one if possible, okay? Or depending on the scenario, I'm very sincere with the client. I said, maybe you're better off going to a private lender, getting a private lending just for that, and then we come back and refinance that one.
Perfect, okay. How long do you typically need? Like if a client is working with you and they're putting in a financing condition, how long should they put into their offer? Do you need 5 days to come back or 10 days? Like what are we kind of looking at right now? I know it's challenging, and I know appraisers are crazy backed up. So, I mean, realistically, you can't be sure of the final approval usually for, I've seen up to a month for appraisals to be done.
Exactly. I had one appraisal done in Montreal, okay, outside of Montreal Island. It took almost 2 months to get it done, okay. I had to involve every single one. We had to change the company that was doing the appraisal twice because the deal was about to close and I couldn't have the appraisal done and the final approval because of that, okay. Luckily, the client was able to extend to accept the appraisal. The market was not that hot at that time. But yes, there are appraisals that are taking every 2 weeks or sometimes 24 hours. It varies the location. So all of that comes to affect how the deal can be approved quickly. Or aside the appraisal, how can I get that one done quickly? It all depends on the volume of the day. Okay, and all depends on the deal. Some deals, depending on the amount, I can get it approved in 24 hours. I had deals that got approved the same day. I submit in the morning, got approved by lunchtime. But those are not the regular ones. So I always tell my clients that it's from 48 to 72 hours at least. Business day, business hours, not including weekends or holidays, okay, to get that deal approved. Okay, I always ask the client, try to get as much as possible, but I know that the market is so hot that getting a financial condition is hard. If you put it there when you lose the deal, but if you are able, at least 5 business days, please, okay? If not, then you need to work with me before to make sure that you qualify, you get it approved. Okay, then the second portion, that's 50%. The other 50% is the property. We need to qualify the property. We need to see the appetite from the bank to get that property mortgage. Remember, every single lender will lend for specific properties. Okay, that's why it's not every time guaranteed that you're going to get the mortgage. Okay, but I can tell you, with all these years that I'm here working on real estate investment and mortgage, I haven't seen one deal for me that was not approved because of the property. Okay, I haven't seen because of property, the appraisal came lower, $100,000. Okay, so then the buyers, the buyer said, well, I don't want to put another 100,000 as a down payment. Okay, that's the issue. Okay, but aside that one, I haven't seen any other problem. But I would say at least 5 days. But work with me if you cannot put conditions. Work with me. But remember, not having a financial condition, I cannot guarantee that we will get it approved.
Yeah, absolutely. And that was actually, you answered my question before I even asked it, which was how many appraisals have you seen come back low? And I've seen multi-unit appraisals come back low. Below the purchase price, but I haven't seen residential ones in a long time come back lower than the purchase price.
I have seen some coming up more than actually it was paid by the house. I had one condo in Toronto, 2-bedroom apartment that was purchased for $800,000. The appraisal came $926,000.
Oh, that's a nice little bump. The question is, 90 days from now, will it still be doing that, right? And that's our biggest challenge right now is trying to predict what's going to happen in the future. So there are, we're answering questions and there's more and more going in. So I think what I'll do, I'll pick 2 more questions that I think will have the most application to the group. And then for the rest of you who have questions, Andre is absolutely amazing. You can tell he loves to talk and he does a fantastic job. So please just reach out to him afterwards and he'll be more than happy to answer your questions individually. Let's see here. Okay, so someone said, Jenny Lynn said, has anyone experienced asking for a new employment letter every 4 months to get mortgage approval? She says she buys properties every 3 months. Does she really need to send a new employment record every 60 days if you're going to stay with Scotia? So it's basically asking about how long or how often the documentation needs to be updated.
Yes, that's not, those are policies. And if you want to get a lending, if you want to get the money from the bank, you will need to comply with the regulations. So you will ask you for 60 days. There are some exceptions. If you're a client and I have been showing that you're still in the job, the pay stubs match the pay stubs before, and on your bank statement, I see the deposit on the pay stubs, I might get a round of that one. Okay.
Love it. Okay. And there's a couple of questions here that have to do with self-employment and net worth. So my understanding, so the question was, does Scotia qualify on net worth versus income? So it'll be self-employed income if self-employed income is low. Now, Scotia has a private lending division, right? And they would qualify based on net worth. Is that correct?
Yes, and I also have a product called total net worth. So instead of, let's suppose, instead of qualifying just for your income, I can use your net worth to qualify you. There are a couple of exceptions, okay? I haven't done that one for a investment property, just for a second home or primary residence, but I believe you can do it, but I need to review the policy. Everything that I know, I tell you, yes, I know. Things that I'm not sure 100% or don't know, I will tell you exactly. I don't know, I need to investigate.
Gotcha. Okay, love that. Andre, thank you again. Thank you so much, everyone, for attending. Reach out to Andre. I promise he's awesome, and you'll learn a ton of information just by chatting with him. And look forward to seeing you again at another investment event, Andre.
Oh, you're welcome. I'll be glad to come again if you need.
Perfect. Thank you so much. Take care, everyone. Have a fantastic week. See y'all soon.
Bye.
Bye.